How we doing, guys? My name's James Hallett. I am the founder of the Fifth Trading Company, and I'm doing a quick little video on support and resistance for the members that are in my group. We do have a lot of new members that are in there, all sorts of new style traders. So this is basically just going to be a basics on the support and resistance, how to plot it real quick, take into account swing levels, scalp levels, kind of midday, intraday levels for more day trading. So let's kind of get this rolling. So I like to start on the max monthly chart. Reason being, this is where the most data is really going to be provided. Any level that you provide on here or document, realistically, this should be your strongest levels. I like to mark these gold, hence call it like a golden support, golden resistance. You can generally dictate that this may be, a place where the hardest sellers are or the biggest buyers are. Could correlate with supply and demand areas in the market. So let's kind of get this rolling. So I do like to start at the top. I always like to take the high. Roughly that's our high right here around this 37, 38 range. Anytime when I'm plotting these, I like to get the most amount of touches. So it's going to be touches of wicks. That's going to be open and closes of the bodies of the candles. Um, it really will probably fine tune your levels a little bit more doing it this way. Um, just because, you know, the wick, when you see wicks, that's going to be probably your highest spot of rejection to either the downside or the upside. We can see the wicks up here. Obviously, the sellers from the top, we can see, judging by the wicks, that there were sellers from probably 335 and 338 to bring price back down to the 300 range. And then we can see the bottom wick right here. It's really basically going to signal us that there are buyers off this 300 level. Down here, you can kind of see the wicks are, close together along with the closes and opens of the bodies of the candles. So we can take, this range. These numbers, they don't have to be spot on the money. Anything in the market, take it as everything can be within ranges. There's a lot of people pricing in standard deviation moves and whatnot. So, it's just a rough range. If you're someone who needs precise levels, well, maybe the market ain't fucking for you because the market doesn't care what you want. So just take in these rough areas. Right here we got another, tight open close area. Um, this wick we can just make note in case it was some sort of price significance there. Um, I like to use the little three touch rule as well too, so we can see this area here. We get the first touch, second touch, third touch around here, and then roughly in this range. Um, take this low here. Remember, we're on the max monthly chart. We're working our way top down. We could take another little bump right here, a couple touches of the wicks and closes. Then we're gonna roll down to the 10-year weekly. Kind of see price a little more broken down now. A little better. I like to zoom in a little bit more. The odds of QQQ probably going under 150 realistically isn't gonna happen. So again, apply your three touch rule here. Try to find any spot there's significant gaps in price. Always mark the bottom of the gap, the high of the gap, because later if price ever comes down to that level, that can hold some sort of significant value. There was obviously for some reason there was a jump in buyers or there was a jump in sellers that caused price to either gap down or have a slight gap up like right here. So mark these levels because generally if price gaps up, it almost, I don't want to say always, but there's usually a high percent chance that the gap's going to come back down to be filled at some point, usually in that week. Um, so usually on the bottom of the gap, at the top of the gap, you'll probably see buyers or sellers. If we're testing it from the top side, you may see buyers at the bottom of the gap. If the gap breaks, then usually your sellers come in and flush it back down to hit the bottom part, like right here. Again, keep three touch rule. We get some wicks here. Another little area here. Here, like I said, you can color code these if you want to switch the weekly. Switch the weekly levels to red. Um, that may be a little clearer for you, especially a lot of you new traders that are going to be watching this. Color coding is probably one of the best ways to do it if you're new. I've been trading for 4 to 5 years now, so I don't need to color code. I can kind of trust my levels. I know the big monthly ranges for any stocks that I like to trade. So roll down from the weekly chart. I like to use 2 year 1 day. provides plenty of data. Again, start on the top. We'll take from the Corona drop right here. Again, find your multiple spots, touch. We got a couple spots over here, high spot right there, a little gap in price here, gap in price here. Now you're gonna notice this is gonna start to look really ugly. There's gonna be a lot of lines everywhere, and that's pretty normal. If you're a new trader, make sure you got multiple drawing sets. If you're using Thinkorswim, simple as just adding drawing sets up here. you know, have one specifically just for, your support and resistance. Support and resistance is not an edge. It's not going to leverage your trading. This is simply just a roadmap and documentation of where price has been, price has bounced, any significant level. So don't think that this is the holy grail for trading, because it's not. There's much more that goes into this. All right, so we'll break it down here. We'll go to the 4 hour. I like to use the 4 hour. The 4 hour is really going to bring a lot of swing traders, because you see the first half of the day, the second half of the day, a lot of money, kind of floats around on this chart, because if you see how price was the first half of the day, you can kind of get a general consensus of what it's going to do if the next candle's coming. If you had a big green candle in the first 4 hours, we'll look for maybe a possible rejection to the upside in the second half of the day. Or if you see the first red 4 hour candle of the day, expect that maybe price could go, maybe bounce back in the second half. Or if, we're in a bear market like right here, expect maybe continuation. If we blew out a low right here, price continue down. All things to make note of. And when you're looking at support and resistance, you're going to see a lot of retests. What do I mean by that? Well, so we can see like over here, right, in this 300, 298 range, price broke above, right? And then goes to test, let's say, this 310, 312 range, and then it came back down. Price came back down to retest the level at 300. That was now resistance, then turns support. And then we have new resistance up here. So nothing to keep in mind of when you're entering swing trades. If you're the breakout trader, then you're trying to catch that break initially. And then you're going to look to exit quicker. The person who's going to be entering off the retest is a little bit more management to do, because if they're entering on the retest of the support, they have to verify that this thing's going to hold. So if you're buying off the 300 support, maybe you're placing your stop, $1 to $2 lower. If you're running at the money contracts, you're probably going to be looking at a, max $100 loss. If you want to factor in implied volatility, you could probably add another 2 or 3%, judging on whatever your Vegas are. So always look for the retest and price when it's broke. This applies to generally, 4 hour chart, intraday charts. It's pretty much rule of thumb. Any patterns that you see almost always retest to. We have a break and downtrend here, and then price broke up and kind of test this area coming down. It's always good to keep in mind. So again, let's just take a couple of the couple of highs and lows. Any significant little price bounces. Roll down to the hourly. Hourly is also another one of my favorite charts. Um, see a lot of data in here. You can kind of forecast what the market's going to do for most part of the day. So again, take the significant lows and highs. Look for multiple touches. And this is once you get down to the hourly, I would say, the hourly to the 30-minute. That's really where your scalp levels are going to become, because you're kind of now dissecting the short-term price movement. We can see here again, multiple touches, support and resistance. Although when we come down in these smaller time frames, they're not going to be as reliable. But if you're a scalper, you're really looking for any point where price is going to reject. If you're in 100 contracts, 50 contracts, one contract, and you're only looking for that $1 to $2 move, you're looking to get in, bang, get out. Your plan, you exercised it. Good job. Again, we'll take these. And then, if we roll down to the 5-minute now, price is going to look a little different. We can kind of see, traded in this little channel. This was our rough support range. Price looks a little bit cleaner, but like I said earlier, it's going to look a little cluttered. Like this looks like shit. You know what I mean? You're not going to want to draw any patterns on this chart. So if you're going to draw patterns, go somewhere else. Go new drawing set and then draw it from there. If it doesn't bother you, that's great. But I can't draw anything on this or keep looking at it unless I'm on the small time frames, like the 5-minute. In regards to other forms of support and resistance, right? Because we have dynamic support and resistance that can be used through indicators or trends. Let's just create a new drawing set here, video. Right, so dynamic support, that's going to be your moving support and resistance, right? And what do I mean by moving? So if we have a trend roughly right here, we'll zoom out a little bit more, clean up the price a little bit. But this is kind of our overall short-term trend, right? Now we get the low here. We kind of see roughly that this was basically the uptrend. Um, Now the dynamic part, obviously we're creating, new series of highs, new series of lows, higher highs, higher lows. Good. Now, and then we come down here and we test, and then this is where the dynamic support really is. People buy the dip off the trend. Um, if you're using studies, I would say the 9 EMA, probably one of the most common moving averages, often acts like pretty good dynamic support most of the time. You can see, on the weekly, people buying off the 9 EMA a lot. So this is your dynamic support. And if you're looking to incorporate this in your rules of trading, right? So if price ever broke below the 9 EMA, that's stop out. Let's say, you're out of the trade. But every time it does touch 9 EMA, you're going to buy every time off of that. But in cases if it breaks below your initial entry price, and you stop out, that can be part of your rules of trading. So this is going to be some sort of moving dynamic support. We can see a little better case here, more so for the 200 EMA, right? This is going to be this white line. We can see roughly every time the stock comes down and hits 200 EMA, it's activating some sort of bias. This is going to be a good level of support and resistance. And generally, for an example, the 200 EMA, there's always a lot of algorithms in the market, and the 200 EMA has kind of had this perception that it's like the last line of defense between bears and bulls in the market. So obviously, there's going to be a lot of algorithms based around that. And I like to use one of the first touch methods. The first touch of the 200 EMA support will almost always activate a buy algo. Like I said, the first test, you almost always see some sort of wick come off. So we had price hit initially on this first wick right here at around 1 o'clock or lunchtime, and then you see the buyers got right back up. So as a scalper, if you were looking to do that and you see price coming down on 4-hour chart, 200 EMA, just make note that that there's algorithms based around this in the market, that there may be a buyback off this 200 EMA. So usually the first touch, bang, you get the buyback, and then price came back down. Initially ended up using this as support, dynamic support anyways, and continuing to make new highs. So price broke below now, right? So this is going to be now dynamic resistance, right? And it came back up the first touch, or actually the first touch is really back here, and then we saw bam, rejection. It's also a supply zone here. You can usually factor that when candles start to get tight, right at support, and then when price comes back to retest the top of that zone, almost always ends up flushing back down. You kind of see that case here. Yeah, but that's going to be our dynamic resistance. So came back up, test, boom, came down. Same process here, dynamic resistance, came back down. And then if you're going to the intraday charts, like the 5 minute, you'll probably see that the 9 EMA or the 21 EMA may act as better dynamic support and resistance for that. You can see here, price never really closed fully below the 9 EMA. So if that was part of your rules, price broke up at morning, then you probably had a green trade today for the Nasdaq, or if you traded any tech stocks in general. Let's see what else. Yeah, I think for the most part that's really going to be it on the basics of support and resistance. When you are doing these, when you're on these bigger time frames and you see these massive areas of support, like down here, like draw these as you can draw these as full-blown zones, really. It may look a little cleaner to you in price. One of my friends that I trade with, Chef, he's a big zone trader. Really likes the whole idea and price action, because you can kind of formulate some decent risk reward. As an option trader, if you're a premium buyer, you're generally not going to want to play in any chop. That's kind of should just be your rule. Unless you're short op sell. If short op sell, you're probably going to love this chop with the high volatility and whatnot. Just activate this and pull this over. Yeah, price broke out, out of the zone. It's kind of like a buy zone at the top of this the sideways little channel we had here. This was extreme chop when we traded this months ago. Um, Troy absolutely hated this level for those of you that are in TCX and conservative collectors. Um, Troy hated this level with a burning passion. I told him, wait, when it broke, we're gonna see all-time highs. Price ended up, coming back up and doing really well. So I can kind of see that we'll probably end up chopping out on this level for a little bit before making some continuation back up. Because once we clear the supply zone, which will happen probably in an after-hour session, um, when the hedge funds decide to push it through the futures market, I think we'll end up seeing some pretty decent upside for tech anyways. Probably see some money rolling back into that. But yeah, and even in terms of when you're drawing support and resistance, you can use these little zones to create like, if you're coming down on the 5 minute, let's say, you're going to want to buy, let's say you're looking to buy this dip, right? I want to buy the morning dip, mark the pre-market low, right? Here's a pre-market low. And if this is your pre-market high, you take these two levels into account. If the market opens, swap to the 1 minute, market opens, right? Here we come down and we test that support and we saw a gap down in implied volatility, which is a good thing. Volatility gaps down, hedges are coming off the table. Short sellers are probably buying back some of their positions. That's generally a good indication of bullish sentiment for, the stock to rise or an index to rise. But yep. Oh, so we got another pre-market high here. So these are levels you can kind of take into account, and then they can kind of be based off your entry. So you could have bought the dip at support here, or maybe you could have bought this breakout, and then we see, look, price retested that pre-market high. Or you can draw these, like I said, as zones, right? So if you were looking to enter off, let's say, let's say the pre-market high is your entry, um, draw it as a zone. Top of the zone will be our entry point. Okay, right? So this is kind of our chop zone. We're gonna look to enter at the break of the zone. Okay, so price retested, came back up, and then at any point when you are entering, this is going to be, let's zoom out a little bit. This is going to be your risk. Okay, this is going to be how you're going to factor your risk reward. Draw it like this, and if it helps you out, great. Keep it red. Okay, this is what you're risking for, let's say, your potential upside. Here we go. Draw if, let's say, the next support's 320 as an example. Okay, color coordinated green. Okay, this is now your risk reward. Okay, it doesn't look as scary. So if you're a new trader, right? You're looking to become systematic. You have to trade in a system. The market rewards people for trading in a system and doing very well and managing their risk. The minute you step out of those principles, that's where you start to see the negative downside in your portfolio. So imagine only risking, if you're entering at 316 roughly, and then you're only essentially risking, let's say, $1. So if you're in an at the money contract and you're scalping this, you're only risking essentially $50 and whatever other risk exposure that you have in regards to your theta or your vega, if you have any high risk gamma, if you're in front week expiration contracts that have naturally higher gamma and vega. But this is generally a set of, look to take it like this. It's going to kind of take out the emotion behind you wanting to make a successful trade. Like we can see over here, yesterday this was, rough resistance. So you can use this. Okay, well, I'm going to risk it here because I know if price breaks below my red zone, roughly the 200 EMA right here, that, we're probably going to see a significant downside in sellers because you don't want to get caught holding the bag at 310 on $8 drop on on an ETF like QQQ. That shit's going to fucking hurt. And especially if you're in short-term contracts and we have a lot of scalpers who are taking heavy size positions, you're going to get eaten alive by the acceleration of gamma and the sensitivity to implied volatility. So keep note and throw the implied volatility indicator on there. You're not looking for buys and sells, but look to see what the volatility is doing. If you're an options trader, that you're buying or selling volatility at all times. These are, it's the only tool you can trade volatility with. So, like I said, gap down in volatility, great. That's good. If you're a premium buyer, odds are going to be more so in your favor if volatility is coming down. I hope this helped everybody. Like, I'm James Howell. I'm the founder of a fifth trading company. If you're finding this video on YouTube and you're not in the group, just follow me at iHallet with 5 T's. It's IHALLE and then 5 T's. Click my link tree. There's a link right on the bottom. Free Discord, plenty of flow bots, access moderators. Need any help? Let us know. Thank you.